morning, everybody. We'll be starting the webcast in about 1 minute's time. Thank you. Good morning, everyone. Thank you for joining our webcast this morning. I hope everybody is safe and well during this very difficult time. My name is Paul Bacon, and I manage the Datastream service here at Refinitiv. As many of you know, Datastream is one of the largest financial time series database in the industry, with multiple benefits available to our end users. Today, I have the pleasure to introduce Kevin Loane and Brian Davidson, who are senior economists at Fathom Consulting, who we at Datastream have partnered very closely with for over 10 years. This enables us to combine the finest quality content and service in the industry with superior expertise and insight from the team at Fathom. So before we get started, a couple of pieces of housekeeping. If you're new to this webcast system, there's a few things for me just to point out to you. You can use the widget buttons at the bottom of the screen to discover all of the features. You can adjust each of the widget size on the screen by clicking and dragging on the corners. We'd love you to submit questions to us during the session via the Q&A chat box. And at the end of the session, there'll be a pop-up survey that will appear. And we'd appreciate your feedback on this session. The slides and recording will be available on Friday, and they'll be delivered to you via email. So you can review this session if you can't stay for the full period. Just a few technical points. If at any point the slides on your screen seem to be stuck, then we recommend just to refresh your browser. Make sure you click the media player on your screen to enable sound, and that flash is enabled on your machine. All of the sound comes out of your PC, so there's no dial-in number here, so make sure you've got your sound up so you can hear us. So Kevin and Brian will be making a presentation this morning with more of their insights concerning the present economic outlook. And then what we'll do is we'll follow this with a brief questions and answer session as well. So you can push those questions through to us during the session, and we'll come to those at the end. So at this time, I'll hand over to Brian to start. He'll talk through some of their professional insights from Fathom, and we'll see what the economic outlook looks like for Europe, the Middle East, and Africa in the future.
Great. Thank you, Paul, and good morning to everybody on the call. So we're here today to talk about the economic implications of COVID-19 for the EMEA region. So I'm Brian Davidson, one of the senior economists in the team at Fathom. And as Paul mentioned, we've worked with Refinitiv for over 10 years. One of the things we do for them is produce the chart book, which is a series of more than 9,000 charts, which are organized and available via Datastream and Icon. So without further ado, talking about the economic impacts of COVID-19 on the EMEA region. So this chart here, it shows the stringency of lockdown measures across this region. So the darker the shading for each country, the more stringent the lockdown measure is in that country. So what it shows is essentially in almost the entire region, the lockdowns have been quite strict in many countries. So for myself, I cover emerging markets and in particular Africa. And personally, I found the scale of the lockdowns in Africa quite surprising. And I'll touch into why a little bit later on. But essentially, the stricter your lockdown, the more severe the economic impact is likely to be. Obviously, that's fairly logical. If people are asked to stay at home, many of them won't be able to work. Simply speaking, economic activity won't be able to take place. So the key question is really how long these lockdowns are going to last for, how severe they will be. And although most of the world is in lockdown at the moment, there has been some good news that some countries are starting to lift some of the lockdown measures. In the EMEA region, some countries in Africa, Ghana, are lifting some of their lockdown measures. And in particular in Europe, countries like Germany, Austria, and Denmark are taking some measures to lift lockdown. So the key question, of course, is will easing restrictions lead to further spread of the virus? Will it lead to a second wave? And also, how good will that be for economies? There is some evidence suggesting that even though lockdowns, if they're not that strict, people are still socially distancing, they're still not gathering in large groups, going about their daily business as they would. Sweden's an example of that. Their lockdown hasn't been as strict, but one measure we look at is the City Mappers Mobility Index, and you can see that the number of planned trips in Sweden are roughly 35% of the normal amount of planned trips. So although people are not being forced to stay at home, they are choosing to do so, and that's having a negative economic impact. So I'll hand over to my colleague Kevin at this time, who will take us through some more information.
Thanks, Brian. As you will all have noticed on that map, we only highlighted the EMEA countries, but essentially all of them are in some version of lockdown. If we included the whole world, most countries in the world are in some version of lockdown. And it makes some sense for why governments have chosen this route. This chart here you may be familiar with. It shows COVID-19 fatalities across different countries in the EMEA region. And so we've started it in each country when they've had their 10th fatality. And it's on a log scale, so if you look at the y-axis, it somewhat understates increases. This is to allow us to see how rapidly and how quickly fatalities are increasing. There is clearly variation among the different countries in the EMEA region. Some places, such as Italy and Spain and the UK, have been much harder hit by this, whereas some other countries, such as Austria, which Brian mentioned, were better able to contain it at the beginning. And then down at the bottom, you have perhaps more emerging markets, places such as South Africa and Poland, where curves seem to be flattening much sooner. And so this didn't just happen by coincidence. In most of these places, either government policy in order to restrict movement of citizens or to encourage social distancing, at times enforce social distancing, really have been quite effective in terms of slowing the spread. No matter where you're dialing in from, I'm sure you've heard some version of we need to flatten the curve, which essentially means stop the rate of increase in of the COVID virus. And this chart is evidence that most countries have been able to achieve that. The one exception for now is the US. It was hit with the virus much later, and for the moment, it does seem that it could still be increasing. This is important because COVID-19 spreads at an exponential rate. So something that scientists refer to as R0 measures how many people one person who's infected with the virus spreads that to. And if you have a number greater than 1, it means that the spread of the virus in a society will be growing exponentially. So if there were no social distancing measures at all, most epidemiologists estimate that COVID-19 has a spread of around 2.5 or 3. So each infected person passes that to around 3 people. And so if you just simply do the math, as those 3 people then spread it to another 3 people, and so on and so forth, you get this really dramatic increase in the spread of the virus. So what these lockdowns and social distancing measures achieve is it helps to reduce the R0 to below 1. Here in the UK, the scientists estimate that it's already below 1. And from looking at this chart, it appears that it probably is below 1 in a lot of countries. So we know that severe lockdowns help to reduce the R0, the spread of the virus, from around 3 to below 1. What we still don't know is, that's a fairly crude measure, and clearly there are large economic and social costs associated with lockdowns. But it's unclear so far how much various social distancing measures affect the marginal impact on R0. So, for example, instead of saying everybody has to stay at home, if you allowed kids under the age of 11, for example, to go to school, how would that spread the virus? Scientists estimate that that has a fairly minor impact. And then you could think about different sectors of the economy, perhaps different age groups. There's a whole range of different measures and policies that could be put in place that may be consistent with keeping R0 below 1, so preventing this exponential rise, but allowing some increase in economic activity. So as Brian mentioned, as these European countries exit their lockdowns, that's something that we'll be watching closely. On this slide, we'd just like to go through the good news and the bad news. I'm lucky to be able to take the good news before passing it over to Brian. So in terms of good news, I think if you scroll back around a month ago, there was a very big concern that since COVID-19 grew at an exponential rate, many countries would be simply overwhelmed and health systems would not be able to cope. You'd run out of things such as ventilators and ICU beds. That hasn't happened in most places. Thankfully, there has been capacity increases that has helped to slow that. And also, I think what's been really notable is that general public has become much more aware about the danger of this disease, and so has taken measures of their own to try and stop the spread of it. So the first chart shows Sweden, which Brian mentioned. It has become a bit of a politicized example, but their government has chosen not to enforce as strict measures as elsewhere. We can talk about that more if people are interested. But what the chart shows is that the daily new cases in Sweden have plateaued even without as severe lockdowns in other countries. And so there's a bunch of different reasons for that. But one of the main points is that the Swedish public, where possible, has stayed at home. A lot of people are working from home. Even though places are open, people aren't really going there. So that does give us some optimism that you don't need a draconian lockdown for a very long period of time in order to ensure that R0 stays below 1. Another piece of good news is that since this is causing havoc and extremely negative health consequences all over the world, a lot of money and resources are being dedicated to try and solve the problem. So there are over 150 teams now seeking a vaccine. I believe today the first human trials are going live in the UK. Bill Gates is funding multiple vaccines. I think he said he's willing to spend $3 billion, knowing that he'll probably lose most of that, hoping that at least one of them will work. And so while the lead time on vaccines is normally very long, I don't think we've ever been in a situation where so many people and so much money has been dedicated to trying to find one. And so that does give us hope that perhaps we could get a vaccine sooner than an estimate based on previous examples would suggest. Finally, there's also the possibility of medical treatment. And so similar to vaccines, if you can't get a vaccine to protect your population from the virus, it is feasible that you could get some sort of medical treatment, something we cope with HIV by treating the people who become infected. If we were able to come up with a solution that could treat people who got the virus and were still able to survive, then a lot of the negative health and economic consequences associated with the virus would also be reduced.
So, so I'll be the bearer of bad news here. So just to put this in context, the point is really that we're several months into this global pandemic, but there's still a lot of uncertainty on the science. And the consequence or implications of that is that it's very hard to judge what the economic outturns are going to be when we simply don't know what's going to happen with the science. So there were a lot of hopes about, the UK government's initial response was they were thinking that herd immunity might be a viable option, that is, letting a large part of the population contract the disease, develop immunity, and then your R0 will be well below 1. There are some studies, and this is in the bad news section. Again, there are conflicting studies, but the bad studies on this front are the following. So in a region of Germany known as Germany's Wuhan, I forget forget the name, Gangelt, perhaps. It was a city which had a particularly large outbreak of the disease in Germany. What researchers did was test a random sample of the population from that city, and they found that only 14% of the population had developed immunity to the virus. So essentially, that's a very long way off 60%, which is the if herd immunity is a viable policy option, letting people get it, the magic number seems to be 60%. So that would require a lot more people getting the disease than the region that had the worst outbreak in Germany. Another study also using antibody tests was by Dutch scientists. They found that only 3% of the population in Holland, the sample suggested that only 3% of the population had developed immunity. So these studies, and there's a couple more, they suggest that really it's not that many have actually caught the disease, so not that many people have developed immunity. So therefore, that would imply that stricter, longer lockdowns might be necessary. But this is all evolving science, so there are conflicting information here, and we simply don't know what the truth is yet. But hopefully we will find that soon, and hopefully, as Kevin said, there will be a vaccine developed in some quick time.
Thank you.
Kevin?
The good and the bad. Unfortunately, I'll take the ugly. So here we've just put our forecast for Euro area GDP, and we're comparing them with the IMF, which released its World Economic Outlook this week. So there, the IMF is it's a purple line. It's the first one, and what you can see is they're forecasting around a 6% decline in GDP in the Euro area this year, followed by a bounce back, but that bounce back isn't sufficient to get GDP to its average level in 2019. We have a range of scenarios. Some of you may be familiar with them already, an alphabet soup of scenarios. So our V scenario, our U scenario, and our L scenario, and those are shown here. Key things to note is that the IMF is fairly close to our V. So that's just about our most likely outcome. We place a 45% weight on it, and then a 10% weight on the U, and a 45% weight on the L. But even in our V, we have a much more severe contraction this year than what the IMF has. And I think that relates to our assumptions about how much economic activity will take place. The IMF assumes most of the lockdowns will end by Q2, and then you get a big bounce back, whereas we think it'll be a very gradual easing of restrictions, so you're not going to get anything close to normal for some time, with really the bounce back coming in Q4 of this year. Overall, though, the most important thing probably to think about is how does it affect you in the long term. And so if you scroll forward to the end of next year, our V scenario isn't that different to the IMF's central case. The bad news, unfortunately, is that we place a 55% probability that it could be a U or an L. And both of those scenarios, again, relate to the health outcomes, which, as Brian mentioned, are quite uncertain at this time. And so the longer you have to maintain lockdowns, or the less effective any mitigation approaches are, if you get a second wave, or if there's no progress on the medical front, and countries either remain in some form of restriction that gets extremely bad, our big concern would be in the L is that the longer that you drag this out, the harder it is for policymakers to play whack-a-mole with all of the different financial market consequences. And so you could end up in a world where the sudden stop in economic activity actually turns into something much worse, either as workers are fired from jobs and so unemployment increases a lot, or as businesses fail and capital is wasted, and so you lose a lot of productive capacity in the economy. So yeah, so for our V, it's predicated really on an effective policy response, which we've seen, as well as a very good health response. And so most societies are able to function at something approaching normal levels by the end of Q4, and there aren't recurring waves. We don't necessarily know if that's a vaccine or medicine or even just better hygiene standards amongst the general population, whereas the U and the L are really worse health outcomes, with the difference between the U and the L being that the longer a bad health situation remains in place, the greater the chances of a severe financial market dislocations. So the IMF, we would say, is fairly optimistic. They may be right, but most of the risks seem to be skewed in the downside. Fortunately, there's more ugly news, and this comes from the labor market. This is a chart of the Irish unemployment rate. You could show this for most countries in Europe, really. And what it shows is that in 1 month, the Irish unemployment rate went from something that was approaching record lows back to record highs. Ireland was particularly badly hit by the previous downturn due to a very big housing boom. And you can see unemployment there rose to 15%, but that took several years. So far, due to COVID-19 and the inability of people to go to work, the CSO has released their own estimate, and unemployment is already back to 15%. So that's really bad. We've had GDP data out of China, which contracted by 6.8% in Q1. And the French central bank estimates that each fortnight of lockdown reduces their GDP by 1.5%. So in a month, you're losing about 3%, a little bit more. And those figures are broadly consistent with the assumptions that we have when we're laying out our different scenarios. The key thing is that this sudden stop in economic activity doesn't lead to worse outcomes. So the short-term social distancing measures don't affect the medium-term productive capacity of the economy. And so one way that could happen, for example, is if firms are told to shut and they fired their workers, whenever they were allowed to reopen, workers would then have to find new jobs and employers would have to find new workers. That would be very challenging, and it would lead to things we call surge friction. So it would be a higher increase in unemployment. And at the same time, if businesses aren't supported in this period, previously viable businesses, then they may go out of business. And so you get what you would call capital scrappage. And so in order to prevent a short-term sudden stop turning into a medium-term hit, you really need effective fiscal policy. And the good news is that we have seen quite a forceful response by many governments. So the first chart shows you the global budget deficit or balance. So for all countries, this is as a share of global GDP. And as you'll notice, it's bigger than the budget balance that occurred during the global financial crisis. So you're going to see government spending more money on this and much quicker than you did in the global financial crisis. Europe is a notable laggard, I would say, in this regard. There's still ongoing debates and discussions about how to pay for this. And so for the moment, it does seem that that could be something that reduces the strength of the recovery in Europe. We're still waiting to see if some form of corona bonds or some form of debt mutualization occurs. But for the moment, as you see on the second chart, really the U.S. is leading the pack. From my perspective, it was quite impressive to see the Senate pass the fiscal stimulus bill with bipartisan. They passed it unanimously, and it was $2.2 trillion. The chart shows the dark blue is cash or cash equivalent. So in the U.S., many people are literally getting checks in the mail, whereas the green is loans and loan guarantees. So the bank says if a business borrows a certain amount, then they will back it up. I think really to maintain economic activity, you should be trying to have a very large fiscal support package and ideally place more of it towards cash or cash equivalent so that people who are recently made unemployed do have some ability to spend once things reopen. There's questions about how this can play out in the emerging markets. I'll leave that for Brian to discuss, but I think the main thing to think about in Europe is that there is a disparate response. And so Germany, you've seen with a very strong response, whereas places such as Italy and Spain, which have had much more severe outbreaks, actually have more tepid fiscal support packages, and that doesn't bode well for their recoveries there. Overall, we would say that borrowing money in this context makes sense because from a moral perspective, governments have shut down a lot of businesses, and so they should or ought to try and help them through it. But even from a cold, rational perspective, they should ensure that these businesses that were previously viable continue, because that will lead to greater economic activity in the long run, even if it means borrowing money now.
On the emerging market, sorry, Kevin, if I can just make a point on the emerging economies there. We'll just go back to that chart. So one key point is what is the correct policy response in emerging markets? And that brings up questions both in terms of whether lockdowns are necessary, whether they'll be effective. So we've seen in countries like South Africa and India that there have been quite strict lockdowns. I personally question whether they will actually achieve the desired aim of halting the spread of the virus, given that many people, live hand to mouth. Many people in one home. They need to go out of their houses to get food, to get work. So, and the other point, well, on that point, will the lockdown be effective to halt the spread of the disease? I'm not sure. In South Africa, the data suggests that it has been successful so far, which is great. But there are also questions about the economic cost. So as Kevin mentioned, in the UK, for example, the government is supporting businesses. They're giving businesses money as long as they pay their workers. So this is keeping the economic framework intact while the lockdowns are in place. But this kind of fiscal support hasn't been forthcoming in many emerging economies, including India and South Africa. South Africa has announced a really big fiscal package yesterday, which is good news. And the other bit of good news is that there hasn't been a particularly adverse reaction in financial markets due to that fiscal splurge. I think that there was a reluctance from the government to increase fiscal spending so much due to fears that might sell off sharply, bond yields might go up. So that hasn't happened. So I think there is scope for a large amount of fiscal stimulus in the emerging economies, but that will also depend on the country. I think markets will be a bit more harsh on some other African countries, for example. So on that note, I think we'll move on. We do have some material on Africa, and we're conscious that time is short, but we'll come back to that very shortly. Back to you, Kevin.
Sure. Just quickly, the fiscal support packages are being augmented by extreme monetary support too. So in Europe, particularly where central banks are engaging in large-scale QE, this is allowing governments to borrow all the money that's required to respond to the crisis while yields remain low. And again, that will be a different story in other parts of the EMEA region. Quickly, we don't have time to go through each individual European country, but just as a framework, I wanted to highlight this chart. So what it shows is the number of fatalities per million on the y-axis, and then the severity of the policy response on the x-axis. So the higher you up on the y, that means you're having a higher number of fatalities, and the further you are on the x, that means your policy response is more stringent. If you look in the top right of the chart, you have Spain and Italy, which have had both high fatalities and extremely severe policy response. That doesn't bode well, because one of the sad things is that it's very quick. Fatalities can rise very quickly, but they drop slowly. So it's going to take some time for those restrictions to be safely relaxed. Whereas those countries in the bottom right are really the ones to look at, and we would call those the ones that are doing responsible reopening. And so even though their fatalities are quite low, their policy response has been extremely strict, and that's places like Austria and Denmark and Germany, which are now able, due to containing the virus, able to at least attempt some form of relaxation. We've highlighted Sweden, where the short-term economic hits has been less severe, and the policy response has also been less strict. How that plays out in the medium term remains to be seen. Finally, here's just the European equities. I think partly due to large-scale fiscal and monetary support, equities haven't fallen as much as they did during the global financial crisis. This is a puzzling thing to many commentators, and we would say the risks are skewed to the downside, and something that we can discuss if you have any questions, but I'll pass it over to Brian to talk about EMs.
Thanks, Kevin. So we do think that financial markets are really underpricing the severity of this recession, and there are many reasons to believe that it could be severe. So if people are in lockdown in emerging countries, or in any country for that matter, and they don't have government support, if businesses don't have government support, they will simply go out of business. And I believe this is the case in India, where the government has said, don't lay off people, but they haven't given a really significant amount of money to those companies. So they're simply running out of cash, and that will cause lasting economic damage. So that's the key point, and that would be one of the factors that would underpin our U and L scenarios, as well as things like the spread of the virus and whether a second wave is possible. So that seems to really be underpriced. So what we have on this slide is the oil price, and oil markets do seem to be pricing in something more severe in terms of the economy. rather than while equity markets aren't. So obviously there have been some supply issues. There's been disagreements between Saudi Arabia and Russia, two of the largest producers, about supply. They increased supply at a time when global demand was falling. But supply, in our view, is just a small part of the story. The main driver for this, for these incredible price drops, and this is the price of WTI, which went down to minus $35 a barrel at one point, which is really incredible. This highlights a real lack of demand, and that is due to the lockdowns and reduction in economic activity. So this is particularly relevant for Africa and the Middle East, which many of the listeners on this call will be interested in. The second chart below shows our estimate of net fuel exports as a share of GDP in a selection of countries. So you can see there are many African and Middle Eastern countries on this list, and a huge part of their economy depends on exports of oil and gas. Needless to say, with prices having fallen so far so fast, this is going to cause a hit to economic activity in these countries. Youth unemployment, general unemployment is already high. It's going to get higher due to the fall in the oil price, not to mention the fall in global demand for other exports due to this entire pandemic. Commodity prices, other commodity prices are down. That will affect countries like South Africa, other African countries like Zambia, which appears to be teetering on the brink of defaulting. One of the tools we have at Fathom is a financial vulnerability indicator, and that shows that many African countries are at risk of a sovereign default. It also shows that some countries, particularly oil exporters, are vulnerable to currency crises due to the really rapid declines in the oil price. So sort of an overview of the MENA region in Russia. The top chart shows the number of cases from a selection of countries in the MENA region, as well as Italy, and you can see that so many countries in the Middle East haven't been nearly as badly affected on a per capita basis as Italy and some European countries. That said, there have been a lot more badly affected than China and many African countries as well. So it's unknown still whether the disease spreads as rapidly in warm climates. It does seem to be the case that it might not spread as rapidly. For example, reported cases in Africa are much lower than other places. Obviously, the weather's warmer, it's more humid. There also could be testing issues in many African countries. So in terms of what the right policy response is, again, it's hard to say, but as the chart, the bottom chart shows, it shows the number of physicians per capita, as well as the number of hospital beds per capita in the top 10 most populous African countries. And you can see, so those are the green dots, and compared to the blue dots, which are a handful of more advanced economies, the healthcare systems in Africa are really grossly underprepared for a significant outbreak in this disease. So far, it seems that they haven't been overwhelmed. The lockdowns have been put in place to avoid this from happening, but it remains to be seen whether that's the right policy, and it certainly will have very high economic costs, particularly as governments aren't supporting businesses. There are also political considerations. It's been reported in Nigeria that the authorities enforcing lockdown have killed more people by enforcing the lockdown than the virus has itself. So it seems that some of these, excuse me, it seems that the policy response really has maybe been slightly disproportionate in many of these African countries. So moving on, we've got a couple more slides, then we'll open the floor for questions. So here are a selection of charts highlighting some of the challenges faced by the UAE and Russia. We know we have callers on the line from those regions, people that are interested in those regions. And clearly, the oil price is one of the main, what was probably the main driver for these countries. And you can see a very close correlation between Russian equities and oil prices. So the sharp declines recently are certainly bad news for Russia's economy, as they are for the UAE and several other countries in the MENA region. The key challenge really for some countries, and one of the main risks to financial vulnerability, is countries that are reliant on oil that have currency pegs, of which the UAE is one. Its currency, the dirham, is pegged to the dollar. You can see its foreign reserves are fairly high as a share of GDP. They have been a lot lower in the past. They're about 25, 30%, but they did fall very sharply after the 2008-2009 crisis. So they do have ammunition to maintain that currency peg, but if oil prices remain low for a long time, as they probably will, these FX reserves are likely to dwindle. And Kuwait, for example, that flagged as the third most vulnerable country to a currency crisis on our financial vulnerability index. It also has a currency peg against the dollar. There's also a chart there showing tourism receipts as a share of GDP, and with the virus spreading rapidly, tourism has virtually ground to a halt overnight. That is roughly 5% of the UAE's GDP, which is it's a big chunk of economic activity which has basically disappeared overnight. It's also an issue for South Africa, not quite as big an issue, but there are some countries, the likes of Mauritius and Seychelles, whose more than 30% of their GDP comes from tourism, and that's been wiped out. So, there are financial stability concerns for many countries in the world, and international assistance certainly will need to be forthcoming. And in many cases, this has been quite slow, or it hasn't happened so far. We've had a question about what the assistance will be to the developing countries, and it's going to be very important to avoid really widespread economic damage in these countries, as well as social and healthcare and human damage. The G20 were trying to reach an agreement on financial aid, but there were disagreements about what channel that should come through. And for now, it remains elusive, and the problem for many of these smaller countries, African countries, is growing by the day. This is our our last slide. It's on my screen. There seems to be an issue with the chart in the top right-hand corner, but if you can see it, that is our the rankings of our sovereign financial vulnerability index. It shows that a few African countries are in the top 10 most likely to experience a sovereign crisis globally. So Zambia, Angola are there. The riskiest in the world is Venezuela and Lebanon. So on South Africa, there's questions about that. As some of you might have noticed, I have a slight South African twang in my accent. I'm calling from London, but grew up in South Africa, so I'm well aware of the stringency of the lockdown there. Notably, you can't buy alcohol, but on a more serious note, there really are serious concerns that people that live hand to mouth will not be getting the support that they need, which I think is why the government announced such a large fiscal package on Tuesday. The chart on the bottom right, that shows the twin, it's not twin deficits for all countries, but it is for South Africa. So on the y-axis, we have the primary balance. That's government borrowing less interest expense as a share of GDP, and on the x-axis is the current account balance. So South Africa is one of the dots in there, and it runs a deficit on both of these measures, which does make it particularly vulnerable to tightening of global financial conditions. On the one good note, I would say, is that the central bank announced the QE program a few weeks back, and that did stabilize the bond market. The currency is obviously sold off pretty sharply due to factors such as the country having a large current account deficit. But the fact that QE was introduced in an emerging market and that's been implemented in Brazil and Thailand, really it's kind of unprecedented, and there hasn't been a very negative reaction in markets. So that will help the government borrow more money without paying very high borrowing costs, and that's vital for a country like South Africa. What I would say as well is that on my screen, the top right chart has suddenly appeared. Is that South Africa being a big African financial hub, if there are defaults in countries like Angola and Zambia, that this will affect markets in South Africa. South Africa will be lent to these countries, and African countries also account for a large share of South Africa's exports. So the African continent could be really the worst hit by this virus of any place globally in terms of the economic impact. The healthcare impact that remains to be seen. So we're really just about ready to wrap up. On the last slide we have here, this shows our chart book that we have created, and we maintain it, and it's available through Datastream and Icon. So we have several of the charts that we've included in today's presentation are in here. You can search by topic, you can search by country. There's thousands of charts in here, literally, with very interesting economic data. Some of the hot topics are charts and a selection of material chosen by us. We maintain this on a weekly basis. We're updating these COVID charts on a daily basis. So if you are a Refinitiv user and a user of Datastream, you should certainly check out these charts. There's really some great information there. So I think really that's it in terms of the presentation. We've had a few questions come through, so I'll just scroll back and see if we can pick any of them up. One question was...
There's one on the V, the difference between our V and the IMF. And so for us, the key difference, we think, we don't have the quarterly path that the IMF assumes. But if you look at their assumptions, they broadly assume that most of the lockdowns end by the end of Q2. And so I think they estimate 8 working days are lost in calendar 2020. And so even in our V, we think that that's too optimistic. And so we think that there's going to be a sharper fall. But since we also expect in that scenario for government policy to be effective and for businesses to be given loans to bridge them across, we have a much stronger bounce back next year. So it doesn't fully compensate, and IMF is a little bit higher in 2021. But that's the key difference between us and the IMF, I believe.
There was another question about Sweden and whether we think economic activity will be as badly hit there as in other countries. The answer is no, not as badly as other European countries, but yes, the impact will still be severe. We're waiting to obviously get reliable the economic data. The lockdowns in many countries in Europe started to happen in early to mid-March, which is the third month of Q1. So we won't see the full effect of these things in Q1 GDP. Also, some of the indicators for these countries, the hard data haven't come out yet, but we have seen in PMIs that there's been a very sharp contraction, and in other metrics, reporting daily activity and so on. So we think the effect will be very severe, including in Sweden, not to mention that if all of Sweden's neighbors are in lockdown, Swedish exports to those countries are going to be falling a long way. So, for example, something we have looked at is the City Mappers Mobility Index, as I mentioned earlier on, and people activity is about 30% as usual, as it normally is in Sweden, whereas it's about 10% in the UK. So people are doing more things, traveling around more. So economic activity, we believe, will be higher, but it's nowhere near normal levels. Just something on that point is South Korea was one of the countries which has been first hit by the crisis. They started to warn their population about the virus quite aggressively in mid-January, and they've gradually ratcheted up their restrictive measures. But by and large, the economy has remained open, and they've avoided a full lockdown, and that's in large part due to their good handling of the crisis. A lot of testing, embrace of technology to do contact tracing and so on. And GDP came out for South Korea overnight, and its economy contracted by 1.4% in Q1. So that's an encouraging number, in my opinion. It shows that economic activity hasn't plummeted despite it being a very large trading partner of China, despite some restrictive measures being in place since February. So that does offer some encouragement, and the contraction was a lot less in China, which on a quarter-on-quarter basis was almost 10%, and we think it's likely to be even larger in many European countries and in the U.S. So I think that's all we've got time for. So I'll hand back over to Paul. So thank you very much for everyone that was listening and for being with us today.
So thank you, Kevin and Brian. A really fascinating session. So I just wanted to point out a couple of things before we finish up. Actually, as Kevin stated, subscribers to Icon and Datastream have access to these charts by the Datastream charting chartbook tool. You can go in there and look at the chart of the day, the recession watch that Kevin mentioned, and we also have our hot topic section with all the charts that have been created by Fathom. These follow the world economic and political events, a great resource for all of our users to monitor COVID-19 as it impacts financial markets globally. As a user, you can click on these charts, customize them, put your own style, add additional series, and there's actually over 9,000 different charts for you to go in and play around with there. We're constantly updating our Datastream service with more and more content, lots of new data for China, emerging markets, and obviously series around coronavirus. During this session, obviously we focus heavily on the charting side, but you can access all of this data through our Excel add-in, our API and FTP service. We've had a huge amount of questions come in, and I really appreciate everyone being interactive and sending those through. Unfortunately, we're running short of time, so we won't be able to answer them all on the call, but we will respond to everyone individually. I think there's some fascinating stuff around Brexit and individual countries as well. So finally, thanks to Kevin and Brian and our friends at Fathom for putting together a really fascinating session. We really enjoyed it. And thank you everyone else for taking the time this morning. And I wish you all a good morning and a good day. Thank you.
Thank you.
Thank you.